Hello, so this is for the subject capital markets, and this is the last topic, capital markets theory. Okay, so let's begin. So the material that we're going to use is the book Capital Markets by Norma Z. Lopez-Mariano. All right, so let's read on. For the introduction, I think this is an article from PNA, Philippine News Agency, last 2017, and it's a news about the PSE, okay, Philippine Stock Exchange. So PSE PDS design merger deal in next few weeks, TCAT, okay. PSE expects to formally sign within the next few weeks an agreement detailing the terms of its merger with the fixed income exchange, boosting hopes their consolidation may finally push through. The game plan is to basically have a formal signing, which can happen in the next few weeks. Formal signing of the deal and agreement, PSE President and CEO Hans Sika told reporters. Sika said the term sheet to be signed is the detailed version of its deal to acquire the Philippine Dealing System Holdings Corporation, or PDS. So PDS is the holding firm for Corporate Bond Bourse Philippine Dealing Exchange Corp. He said the Bankers Association of the Philippines serves as the main counterparty in the transaction. BAP has 28 to 29 stake in PDS. The PSE also forged selling agreements with various minority shareholders who own a combined 31.1% of PDS. Okay, so about this news, this highlights the Philippine capital market. PDS is a private corporation which, through its subsidiaries, provides financial market infrastructure to operate trading platforms, manage sound settlement highways, and render essential security services in the Philippines. The company offers trading, listing and enrollment, data, clearing and settlement, and payment and transfer products and services. Okay, and I think they're being used by various banks or other financial institutions. It also provides depository services, including secure settlement, core safekeeping, and corporate action activities for community members. Electronic and real-time access for members to keep track of balances under guardianship, and tax services for equities and fixed income markets. In addition, the company offers market data on government securities, corporate securities, interprofessional repurchase, depository safekeeping, foreign exchange summary, registry, record keeping, essentially a lot, payments and transfers. So it was founded in 1997, based in Makati. Merger of PSE and PDS is to enhance the liquidity in the financial markets, including capital markets, right? At this juncture, we will now study the capital market theory. Studying capital markets will not be complete without studying the capital market theory. So this is because capital markets should include a study of the underlying theory covering its operation. Capital markets deal with long-term debt and equity securities. So capital market theory extends portfolio theory and develops a model for pricing all risky assets. It is a model that seeks to price risky assets, most commonly shares, in terms of trade-off between the return sought by investors and the inherent risks involved. So this model is referred to as the capital asset pricing model. So we have different securities in the capital market. Again, we have the debt securities and then the equity securities, okay? And then in the Philippines, of course, publicly traded equities are being sold at the PSE, and the PDS is the one mainly involved with the trade of bonds, okay? But I think with their merger, so it's under PSE, okay? I'm not sure if it pushed through though. We'll check, okay? So in previous videos, previous lessons, we've discussed the different, the concept of risk and return, and we know that the different types of securities would have different risks. They would be involved, they would have different types of risk depending on a lot of factors, and their prices would sometimes depend or would be affected by the different risks that they are involved with, okay? So for the following theories, we have Markowitz portfolio theory. Capital market theory is built upon the Markowitz portfolio theory. Markowitz portfolio theory identifies as efficient frontier, which is a set of efficient portfolios. So we know in investment, the investment must be diversified. So you have your portfolio, and it should be composed of a variety of securities. So you have your bonds, you have your equity, you have your short term, you have your long term, and then you have investments in various businesses that are involved in different industries. Okay. An efficient portfolio represents that set of portfolios with the maximum rate of return for every given level or risk, or the minimum risk for every level of return. So it's trying to, balance out the return and the risk. The return that the investor wants to achieve and the level of risk that they are willing to accept. Okay. It is that portfolio which has no alternative with the same higher expected return of portfolio and the same lower standard deviation. So standard deviation, it's, the fluctuation of the returns. So the lower it is, the better for the investors, because they have that, expectation that the return would be around the same area, or it would not fluctuate so much. Okay. Nasdaq.com defines portfolio as a collection of investments, real and financial. Real, I think, properties. Okay. It is a collection of all assets available to investors, with each asset held in proportion to its market value relative to the total market value of all assets. Okay. Again, portfolio collection of investments. According to Demuth, economist James Tobin discovered in 1958 that while there are many portfolios available to an investor, there is only one super efficient portfolio that cannot be improved upon. Although, I believe that is relatively difficult to achieve, right? It sits on a knife edge where any change you make is a change for the worse, delivering poorer returns for more risk. In 1964, Nobel economist William Sharpe proved that Tobin's superefficient portfolio was none other than the market portfolio, the portfolio of all risky assets proportionally weighted by their total market capitalization. So essentially, it's a portfolio with the highest return. Brandeis University Mictom School of Computer Science elaborated on the market portfolio. Basically, market portfolio has three observations. First one, each investor will want to hold a certain positive amount of each risky security. Okay, because the riskier the investment is, the higher the return, right? So in a way, when they're creating a portfolio, there would be some investments that have high risk. Okay. Secondly, the current market price of each security will be at a level where the number of shares demanded equals the number of shares outstanding. Okay, so that the price would be representative of the actual valuation of the company. Because if there is less number of shares outstanding compared to the number of shares demanded, then there is a possibility that the price would go up irrespective of the actual value of the company or the business. Number 3, the risk-free rate will be at a level where the total amount of money borrowed equals the total amount of money lent. Okay. This gives rise to the following definition of market portfolio. Market portfolio, a portfolio consisting of all securities where the proportion invested in each security corresponds to its relative market value. So the higher the market value, then the proportion would be higher as well. And the lesser the market value, then its proportion is also smaller. The relative market value of a security is simply equal to the aggregate market value of the security divided by the sum of the aggregate market values of all securities. So for example, you have security A, total amount is 10,000 because, the price per share is small, right? Let's say 5 pesos, right? Times, how much? 2,000 shares. So you have your 10,000 pesos. And then you have company B, let's say 100,000 pesos because the market price is higher. Let's say 50 pesos, okay, times 2,000 shares, so you have your 100,000 total market value. Okay, and then you have company C. Let's say the market price is 200 pesos per share. So the company is holding, let's say, 5,000 shares of that. So how much is that? 1 million pesos. So essentially, the valuation of each of these investments would depend on their market value. And the higher it is, then, the higher is the aggregate amount as well. And the smaller is the value, then the smaller is its proportion in the investment portfolio. Okay. In equilibrium, the proportions of the tangency portfolio correspond to the proportions of the market portfolio. This tells us that the market portfolio plays a central role in CAPM, capital asset pricing model, since the efficient set consists of an investment in the market portfolio coupled with a desired amount of either risk-free borrowing or lending. Okay, so we have an illustration here, figure 31, capital market line. M is the market portfolio, so this one, this line, and then you have R. This point here represents the risk-free rate of return, and then all portfolios other than those employing the market portfolio and risk-free borrowing or lending lie below the CML, or the capital market line. Okay, employing market portfolio and risk-free borrowing or lending lie below the capital market line. Okay, so yun lang daw tawag dito. Yun lang nag-i-implement ng market portfolio, tapos yung kanilang rate of return is essentially risk-free, considered risk-free borrowing because let's say government bonds yan or blue chip companies. So yung kanilang risk-free borrowing or lending lie below the CML, capital market line. The linear efficient set of CAPM is known as the capital market line, which has the following equation. Okay. What's this? F, expected return of an efficient portfolio, equals R, risk-free rate of return, plus, again, the F sub M is expected return of the market portfolio, minus RT, risk-free rate of return then, over QM, sorry, is this omega M? Omega sub M, standard deviation of the portfolio, of the market portfolio, multiplied by the standard deviation of the efficient portfolio. Okay, so this is the formula, but let's see if they have, an example. We now know that by using CAPM, we can decide whether the market price for a stock is too high or too low by looking at the market portfolio. Although there are certain agencies that provide, indexes for certain types of investments. The expected return of a market portfolio is identical to the expected return of the market as a whole. A market portfolio is completely diversified, hence it is subject only to systematic risk and not to unsystematic risk. Okay. Capital market theory assumptions. So the main assumptions of the capital market theory, according to Rayleigh and Brown, are the following. All investors are efficient investors. That's the main assumption, but is that the truth? I think that's far from the reality, right? Given the accessibility nowadays of the different, investment platforms, there are a lot of newbie investors that are not yet knowledgeable with investment, and so I wouldn't say they're efficient. Okay, they chose to invest in portfolios along the efficient frontier, the exact location on the efficient frontier, and therefore the specific portfolio selected will depend on the individual investor's risk return utility function. Okay. Secondly, investors can borrow or lend any amount of money at a risk-free rate of return. The thing is, here in the Philippines, short selling, that's not done here in the Philippines. So, borrowing money to invest is not done. Okay. In the US, yes, but here, no. Government-issued securities are considered risk-free securities. Risk-free securities are securities with zero standard deviation and zero correlation with all other risky assets. So they provide the RFR, risk-free return. Okay. Government issued securities because governments are essentially very stable and they are being funded by, taxes normally. And so, they're very safe, or there's a, what do you call that? There's a surety that they would be paying the returns, right? And so they only provide a low rate of return as well, okay, because of the low risk. Yeah, right? Third, all investors have homogeneous expectations. That is, they estimate identical probability distribution for future rates of return. Again, not in reality, okay? All investors have the same investment, one period time horizons, 1 month, 6 months, or 1 year. All right. So essentially, these are also the limitations of this, theory. Okay, because some of them are not what's currently happening in reality. Okay. All investments are infinitely divisible. Fractional shares of any portfolio can be purchased or sold. This one could be. There are no taxes or transaction costs involved in buying or selling assets. That is, investors' results are not affected by taxes and transaction costs. There are transaction costs, okay? And then, of course, dividends are normally subject to taxes, and then huge capital gains are normally subjected to taxes as well. There is no inflation or change in interest rates, or inflation is fully anticipated. Returns are not affected by the inflation rate in a capital market. In previous videos, previous discussions, we did say that inflation does affect the actual return on investments, okay? Capital markets are in equilibrium. All investments are correctly priced at par with their risk levels. Okay, again, reality, nope. Majority of the companies are, of course, priced according to their valuation, proper valuation, but there are certain companies which are not priced, in accordance with their risk levels. Okay. Again, not here in the Philippines. If you've heard about the GameStop situation, so there were hedge investors or hedge companies that were short selling GameStop, and so this community on Reddit bought the stocks and drove the price too high, which is not, the price is not supportive, or it's not supported by the actual valuation of the company. So really, it's bound to be a disaster later on. So, there are a lot of people who came to that situation, who bought the stocks at high prices only for it to start going down, and so they lost their money, right? And so not all investments are correctly priced at par with their risk levels, okay? So we're going through the assumptions for this particular, capital market true assumptions, and we're just saying that not all of these are actually happening in reality, okay? So the assumptions are already not realistic. Okay, and then all assets are included in the market portfolio in proportion to their market value. That's possible. Market portfolio contains all risky assets and is completely diversified, meaning all the unique risk of individual assets is diversified away. Okay, majority of portfolio, of course, we follow this diversification so that we can minimize the risk. Okay. Some of these assumptions are unrealistic, yes. Relaxing many of them will have minor influence on the model and will not change its main implications or conclusions. Remember that a theory should be judged on how well it explains and helps predict behavior, not on its assumption. Okay, so essentially, if these assumptions were true, then the resulting or their prediction would have been correct. Okay, so let's discuss capital asset pricing model. CAPM was developed when William Sharp, a 26-year-old researcher at the Rand Corporation, a think tank in LA, introduced himself to a fellow economist named Harry Markowitz. Sharp, then a PhD candidate at the University of California, LA, needed a doctoral dissertation topic. He had read Portfolio Selection, Markowitz's seminal work on risk and return. Sharp accepted Markowitz's suggestion that he investigate investigated portfolio theory as a thesis project. From this research, Sharp independently developed a theoretical notion of investment risk and reward, a sophisticated reasoning that has become known as the Capital Asset Pricing Model, or CAPM. Okay. Sorry. CAPM explains that every investment carries two distinct risks, so the systematic and then the unsystematic. So for the systematic, the risk of being in the market, and systematic is the risk specific to a company's fortunes. Okay. Systematic risk, later dubbed beta, cannot be diversified away. Okay, it affects everyone in the market. And systematic risk is an uncertainty that can be mitigated or lessened through appropriate diversification, or it's it's specific to, let's say, particular industry or particular companies. So in that case, it can be mitigated through diversification. Sharp figured that a portfolio's expected return hinges solely on its beta, its relationship to the overall market. CAPM helps measure portfolio risk and return, and the return an investor can expect for taking that risk. It explains the relationship that should exist between the security's expected return and the risk in terms of the means and standard deviation. So means is, just the average. You get the historical data in the last few years and then divide that by the number of years. Depending on how much information have you gathered. And then the standard deviation, again, with that same information, you can see how the returns or how specific items have fluctuated over the years in relation to that particular company or particular industry. Okay. All investors can satisfy their investment needs by combining the risk-free asset with the identical tangency portfolio, which is the market portfolio of all risky assets. Okay. The following equation describes the expected returns on all assets and portfolios, whether efficient or not. So what's this? E of R, expected return on asset, and then you have your R, risk-free rate of return, beta, COV, what's this? Cow. Okay, and then you have your E of R sub M, expected return on the market portfolio. Okay. The graph for this equation is called the security market line. Security market line is a graphical representation of CAPM, a basic estimate of the relationship between risk and return in a stock price. By estimating the SML and comparing it to actual historical returns of a stock, an investor can get a sense of whether the stock is undervalued or overvalued based on the investor's assumptions about future performance. So again, this would require assumptions, and the assumptions, if you're this investor, of course, you want it to be as realistic as possible, and you need to be informed to make those proper assumptions. Okay. If returns are consistently beneath the SML line, the stock is expected to rise, and if the returns are consistently above the line, that stock is due for a drop. Okay, so this is probably one of the tools that investors or market analysts are using to to see or to check if the company is undervalued or overvalued. Graphing the SML for a particular stock requires a calculation of the stock's beta, which is how closely it adheres to the overall performance of the market. A stock with a beta higher than 1 outperforms the market, and a beta less than 1 means it underperforms the market. Okay, so you have this figure. You have the risk-free rate of return, you have your beta, you have your expected return on the asset. This is M. Okay. CAPM is an equation describing the expected return on any asset or portfolio as a linear function of its beta. So depending on the beta that would affect the investment or the portfolio, then it would of course affect the return on that particular asset. Alright, a measure of the asset sensitivity to movements in the market. CAPM states that Expected return has two components. So first is the risk-free rate, and second, an extra return equal to the beta. Okay. The term E of R sub M minus R sub F is the expected excess return on the market. The market risk premium. Okay. So of course, if the risk of a particular asset is above the risk-free rate, so the difference from that risk, the difference of that actual risk and the risk-free rate, that's the risk premium. Okay. If we are to invest 100% in the market risk premium is the extra return we expect to obtain on average. Okay, because that's also, equal to the amount of risk that we're going to take for putting our money in that particular investment or portfolio, compared with the risk-free rate of return. The market risk premium is multiplied by the asset's beta. A beta of 1 represents the, average market sensitivity, and we expect an asset with that beta to earn the market risk premium exactly. Okay, 1. A beta greater than 1 indicates greater than average market risk, and according to CAPM, earns a higher expected excess return. So if it's higher, the risk is higher, so the expected return is also higher. But again, it's only the expected, okay, not the actual. And there's also the possibility of losing more money because you're taking on a much higher risk. Okay. Conversely, a beta less than 1 indicates less than average risk, and according to CAPM, earns a smaller expected excess return because it's, less than. And then expected excess returns are related only to market risk, represented by beta. Sensitivity to the market return is the only source of difference in expected excess returns across assets. How sensitive is that particular asset or portfolio to the market risk or the other risk available to it, or other risks that it is exposed to. Okay. The market portfolio itself has a beta of 1. Beta of the market portfolio equals COV RFRM divided by the is this covariance and variance of R sub M. Okay, equals the variance of R sub M divided by the variance of R sub M equals 1. Yes, same lang naman Okay. Because the market portfolio includes all assets, the average asset must have a beta of 1. The same argument applies if we compute the betas of assets in an index using the index to represent the market. So parang index na lang din siya. Okay. If the particular assets in performance is similar to the index, then it's to say that it's doing as well as the whole industry, okay, or the whole market. One intuition for this idea is that the market is the perfectly diversified portfolio because essentially it has everything. We can cancel out any other risk by holding the market portfolio, and we can costlessly hold the market portfolio by the no transaction cost assumption. Even risk with respect to personal assets, such as human capital, can be diversified away. Investors should not require extra return for risk they can costlessly hedge. Okay, so if you can mitigate a risk and lower it, then essentially you're lowering the risk. And if you're able to do that, then you can expect that the return would be lowered as well. Okay, since you're already mitigating the risk. CAPM describes a financial market equilibrium in the sense that if the model is correct and any asset's expected return differs from its expected return, as given by CAPM, market forces will come into play to restore the relationship specified by the model. So for example, a stock that offers a higher expected return than justified by its beta will be bid up in price. Investors would expect that a broad-based portfolio would offset any non-market risk the stock might carry. Alright? Because it is all-inclusive, di ba lahat na all investments are in the market portfolio. The market portfolio defined in CAPM is an observable. It's essentially the market. In practice, we must use a broad index to represent it. CAPM has been used primarily to value equities, or stocks, So a common choice for the market portfolio is a broad value-weighted stock index or market proxy. The straight line relationship between expected return and better results from the efficiency of the market portfolio. In PSE, diba, we have PSE index, which can also be bought by by investors. So if you don't want to bother with checking individual companies, you can just purchase the PSEI. Okay, it's composed of, I think, market players, right? As a result, CAPM theory is equivalent to saying that the unobservable market portfolio is efficient, but not that any particular proxy for the market is efficient, or of more interest to practitioners than the CAPM as a theory is whether beta, computed using available market proxies, is useful for evaluating the expected mean return to various investment strategies. Okay. Nagagamit ba? The evidence now favors the existence of multiple sources of systematic risk affecting the mean returns to investment strategies. So, with the different types of risk that investments or portfolios are being exposed to, so medyo, mahirap din na i-determine yung, pricing models for those investments. Or if the valuation of those investments are, correct, or if they are undervalued or overvalued. Okay, next we have the mean variance analysis, part of the modern portfolio theory that deals with the trade-offs between risk as represented by variance or standard deviation of return and expected return. Mean variance analysis assumes the following. So, firstly, investors are risk averse. They don't like risk. They'd like to mitigate the risk as much as possible. Second, assets expected returns, variances of returns, and covariances of returns are known. So you have to compute for these figures. Okay, you have to know the expected returns and then the variances of returns. Does it fluctuate very much? And then the covariance, which variables does it move to? Okay, so if a certain variable changes, how does it react to that? Does it change in direct proportion to it or inversely to it? Okay. Investors need to know only the expected returns, the variances of returns, and covariances between returns in order to determine which portfolios are optimal. Fourth, there are no transaction costs or taxes. Okay. They simply disregard those items. For any portfolio composed of two assets, the expected return to the portfolio is the expected return to asset 1 plus the expected return to asset 2. Okay, asset 1 and asset 2. Expected return to asset 1 plus the expected return to asset number 2. Okay, so this is the formula for that. In general, the expected return on a portfolio is the weighted average of the expected returns on the individual assets. So essentially, you compute for the individual returns of the assets, and then you get the weighted average of that to get the return on the portfolio. Okay, the weighted average would, of course, depend on the rate of return for a particular asset and its, how much is its composition in the portfolio. Okay. So let's say out of let's say you have 4 securities in the portfolio. If this one is 50% of the total portfolio and the return is 10%, so you have 10% times 50%. If this particular portfolio is about only 20% of the total portfolio and the return is 8%, so you have 8% times 20%. Okay, and then this one is, let's say, another 20%, and then you have your 10%, and then multiply just to the respective rate of returns that they have, and then you get the weighted, of course, the weighted average. The global minimum variance portfolio is the portfolio of risky assets having the minimum variance. An efficient portfolio is one providing the maximum expected return for a given level of variance or standard deviation of return. Okay. Minimum variance portfolio. Okay. According to the mean variance analysis, investors optimally select a portfolio from portfolios that lie on the efficient frontier, of course. By restricting attention to the efficient portfolio, the investor's portfolio selection task is greatly simplified. When the correlation between the returns on two assets is less than 1, the potential exists for diversification benefits. Diversification benefits occur when portfolio standard deviation of return can be reduced through diversification without decreasing expected returns. Okay. Diversification are, the level of fluctuation between the returns. So you'd want that to be reduced as much as possible so that you can freely predict, the lowest amount of possible return and the highest amount of possible return. Because let's say this is, 8 to 10%, right? So you have your fluctuation between that. But if you have a larger standard deviation, let's say the fluctuation is from 6% to 14%, so you wouldn't know. And even if, it's not that you wouldn't know, but essentially the difference is too large for you to, prepare or predict well what is going to be the actual return on the investment. Okay. The introduction of a risk-free asset into the portfolio selection problem results in the efficient frontier having a linear portion that is tangent to the efficient frontier defined using only risky assets. This line is called the capital allocation line, CAL. Portfolios on CAL represent combination of the risk-free asset and the tangency portfolio. When all investors share identical expectations about mean returns, variance of returns, and correlations, the CAL for all investors is the same and is known as CML, of course. If it's the same, then identical. Okay, the tangency portfolio is the market portfolio of risky assets held in market value weights. The implication of the CML for portfolio choice is that all mean variance investors, whether their risk-free tolerance can satisfy their investment needs using the risk-free asset and a single risky portfolio. The market portfolio of all risky assets held in the market value weights. Okay. So that's it. We now have the chapter summary. Okay. It's a lot of, theory to take in, but essentially, we've read a lot about, different assumptions, and again, reality is very far from majority of those assumptions, and so I think the conclusion that I can make is that it would, we would still need more knowledge on these topics, more information on these topics, and of course, the changing information that would affect the different companies, different industries would also, have a weight on how you assess the different types of investments that you want to invest in. Okay. Alright, so let's read on with this. Capital market theory extends portfolio theory and develops a model for pricing all risky assets. It is a model that seeks to price risky assets, most commonly shares, in terms of trade-off between the returns sought by investors and the inherent risk involved. Markowitz's portfolio theory identifies an efficient frontier, which is a set of efficient portfolios. An efficient portfolio is that portfolio which has no alternative with the same higher expected return of portfolio and the same lower standard deviation. A portfolio is a collection of investments, real and financial. Market portfolio is theoretical bundle of investments that includes every type of asset available in the world financial market, with each asset weighted in proportion to its total presence in the market. The expected return of a market portfolio is identical to the expected return of the market as a whole. Because, the components of it are essentially, every type of asset available in the world financial market. Main assumptions of the capital market theory. I'm not going to repeat these, but you can read this, okay, on your own. CAPM explains that every investment carries two distinct risks. This is systematic and unsystematic. And then you have your formula for it. Mean variance analysis is part of modern portfolio theory that deals with the trade-offs between risk as represented by variance or standard deviation of return and expected return. For any portfolio composed of two assets, the expected return to the portfolio is the expected return to asset 1 plus the expected return to asset 2 with equation as follows. Okay, so that's it for this one. It's a lot to take in, so good luck with that. Okay, good luck to us. Alright, so that's it. Thanks and bye.